Ever wonder what the future holds for interest rates on home loans? How will they compare and what factors will influence them? Well, buckle up, because we're about to delve into some predictions and the influencing factors behind them. Picture this. It's April 2024, and home loan rates are peaking at a high of 8.88%. Sounds daunting, right? But don't worry, because by October 2026, forecasters predict these rates will taper down to around 5.5%. But what drives these changes? The Federal Reserve's actions are a significant player. Picture a seesaw. On one end we have a year-end 2023 federal funds rate of 5.25%. On the other, an anticipated drop to about 2% by the end of 2025. Expect the first rate cut in February 2024, followed by steep cuts until mid-2025, bringing the rate back down to between 1.5 and 1.75%. Now let's shift gears and talk auto loans. TransUnion's 2023 forecast anticipated an increase in auto lending due to an easing of supply chain constraints and a rise in car production. Yet, delinquencies were predicted to rise amid a possible recession, with a jump in borrowers 60-plus days past due, expected to climb to 1.95% in Q4 2022. After that peak, delinquencies were projected to edge down slightly through 2023, finishing at 1.9%. Factors influencing the auto loan market include competitive pressures on pricing and a market environment where new car prices are high, creating more significant credit exposure for lenders. Before we dive into the broader economic picture, it's crucial to understand the importance of staying informed and engaged in these financial matters. Why, you ask? Because it's your money we're talking about, it's your future. The more you understand about the economic climate and how it affects loan rates, the better prepared you are to make sound financial decisions. And while we're on the topic of staying informed, don't forget to subscribe to our channel, Infinite Solutions. We are committed to delivering you the latest insights and forecasts on all things finance. Also, if you find this video helpful, please give it a thumbs up. Your support helps us to continue delivering quality content. Alright, now that we've covered that, let's move on to the broader economic picture and how it could potentially impact home and auto loan rates. Stay tuned. Now, you might be asking, what about the broader economic picture? Fitch Ratings anticipates a mild U.S. recession in 2023, which could affect both home and auto loan rates. However, they suggest that the auto industry is better positioned than in previous downturns. Despite a potential recession, companies are expected to hold up well due to a backlog of demand from consumers. So, to sum it all up, the increase or decrease in interest rates for home and auto loans over the next few years will likely be a result of the interplay between economic recovery post-pandemic, Federal Reserve policy changes in response to inflation and economic conditions, and market dynamics in both the housing and auto industries. But remember, these predictions are based on current analyses and economic indicators, and they're subject to change with shifts in economic trends and unforeseen events. So, stay informed, stay savvy, and keep an eye on those interest rates. And now we'd like to hear from you. What are your thoughts on these potential changes in interest rates? Are you considering any major purchases in the next few years? Perhaps a new home or a new car? We're interested to know how these projected interest rates might influence your decisions. Please share your thoughts and plans in the comments section below. Remember, your insights might help someone else out there make a more informed decision. So, let's make this a platform for mutual learning and growth. We look forward to your active participation.